Hello and welcome to BQ Prime. India's GDP growth, according to figures published yesterday evening, has come in at 7.8%. Now, to help us see the big picture and identify and spot some of the underlying trends behind a whole host of this data, we're joined by Pranjul Bhandari, Chief India and Indonesia economist at HSBC. Pranjul, thank you so much for taking time out for us today.
Great to be here, Pallavi.
So, Pranjal, to begin with, I've read your report, and one of the things that you've been saying for a while is that the figures that we saw might have been slightly overstated for a couple of factors, the deflator as well as the base effect. So, all in all, to begin with, I'd simply like to ask that adjusting for that, what have you made of these figures? Do we still how resilient do you think the Indian economy was in Q1?
Yeah, thanks, Pallavi. So the number we got yesterday was 7.8%. Now, this number has a lot of statistical problems in it. And one problem is to do with deflator. There is a problem in the manufacturing deflator and also in the services deflator. In the manufacturing deflator, the problem is that commodity prices fell in this quarter. And what the CSO does is it does something called single deflation instead of double deflation. And whenever that coincides with commodity prices falling, manufacturing growth actually gets exaggerated. Similarly, for services, there's another deflator problem. Our services deflator has too much of goods in it than it should. It should have all services, right? It's a services deflator. But we have a lot of goods in our services deflator. So at a time when goods inflation is falling, which is what had happened in 1Q, services growth gets overstated. So if you add up both these deflator problems, my sense is GDP growth was exaggerated by 1 percentage point. So the 7.8% number was actually closer to 6.8% number in terms of actual growth on the ground. That's one problem. There's a second problem, which is on base effects. From the pandemic days, there is a low base effect problem that is there in the first quarter GDP. It's also there a little bit in the second quarter GDP, but mostly in the first quarter GDP. And my sense is that has also exaggerated growth by about a percentage points. So if you put all of this together, because of statistical reasons, my sense is GDP growth on the ground was close to what it was in the last quarter, around 6%, rather than the 7.8% number that was published.
Got it. All right. So even going forward, the Indian economy continues to see some headwinds. The IMD in its press conference yesterday highlighted that August 2023 has been one of the driest on record. There have already been some concerns around rural demand. We've seen mixed trends, and rural incomes now again seem to be a little bit of a concern. So at this juncture, what does it look like? How do you think that's going to pan out?
Yeah, I think GDP growth number is going to slow from these 7.8% levels. One of the reasons is just statistical. That base effect problem that was there in 1Q will peter off over the second, third, and fourth quarter, and the GDP number will normalize. That does not mean the actual growth on the ground is weakening. It means that the GDP is getting to be a better indicator of actual growth on the ground, that exaggeration in 1Q will not be there. So one is going to be that. The second is that the actual growth on the ground could also weaken if El Nino intensifies in the next couple of months. Now, one thing we are seeing over the last decade is that whenever we have a big climate shock, then generally food inflation doesn't rise very much, doesn't rise as much as we had seen in the previous decade, because we become far efficient in importing, supply side logistics, clamping down on hoarders. So food inflation doesn't really go up. But what suffers instead is rural demand, agricultural production, what farmers earn, and therefore rural demand. So if El Nino intensifies, my sense is that rural demand could weaken and actual growth on the ground could also weaken.
All right. Nominal growth as well came in at about 8% for Q1. Going forward for the full fiscal year as well, there's an expectation that it's not expected to be a very high figure simply because of what we've seen wholesale inflation to come in at. So what's the implication?
I think it has many implications, but an important one for a pre-election year like this year is fiscal implications. It basically means that you may be in a situation where your tax revenues are lower than what you had anticipated at the start of the year, because you started the year thinking nominal GDP growth will be much higher than it's turned out to be. But your expenditure may remain high because of all the pre-election year, pressures you may be facing, right? And we're already seeing it. The government is doing a lot of interventions, and it may do more of those. So expenditure may remain high, but revenues may not keep up. And I think that's going to be an area which will need a lot of focus in the next couple of months. I don't think it's going to be a all-out miss of the fiscal deficit target. I think the finance ministry has a lot of levers to work. For instance, it can slow capex a little bit in the next couple of quarters and make that money available for social welfare schemes. So it doesn't mean it will really blow up the fiscal, but we have to watch carefully.
All right. I'd also want to ask you a little bit more. In your report as well, you've highlighted the variance in tax revenue growth and possible indications of a K-shape there. Can you please elaborate a little bit more on that?
Yeah, I'm glad you brought this up. I think the fiscal data, the tax data we are getting over the last couple of months is rich with information. There's a lot of information in it. And one trend is that direct tax collections have weakened, which is income tax and corporate tax, whereas indirect tax collections, which is GST, continues to remain strong. And I think in a very strange way, at this point, looking at a lot of other data, I think this is an indicator of a K-shaped recovery. Now, what's keeping GST revenue strong? I think one of them is the fact that GST tax rates are higher for luxury products. And I think the demand for that continues to be strong. And on the back of that, we're getting a good revenue inflow. We're also getting a lot of revenue inflow from imported goods, GST on imported goods. And when we look into imported goods, we see a lot of high-end consumer imports are also happening. So a very high-end demand of the economy continues to remain strong, and that is keeping indirect taxes strong. On the other hand, if you look at something like corporate tax collections, it is not doing very well. And if you peer closely, you'll find that true profit margin of many companies improved in the June quarter because commodity prices fell, manufacturing costs fell, but volume growth in many companies was very weak. And on the back of that, overall corporate tax data has been weak. And when I say weak volume growth, I think they have been largely in rural-focused companies. Again, on the back of the fact that rural economy is not doing well. So again, a K-shaped recovery where the rich urban is doing well, but rural is not doing very well.
Okay, Pranjul, correct me if I'm wrong. You've mentioned that volume growth across companies, possibly because of the rural economy, has not been particularly strong. What about IIP? Does not that provide an indication of volume growth? And so far, the last couple of months, we have seen fairly strong index of eight core industries figures. So, I mean, how do you kind of tie this in together?
So look, when you look at IIP, and then if you really narrow down on consumer durables and non-durables production, you'll see that they have slowed. They had gone up at the start of the year, but they have slowed in the last 2 months or so. And particularly the production of non-durables, the staples, has slowed appreciably. It's very, very noticeable. And I think that's an indicator of this, rural demand weakening in the last couple of months. I think the part of IIP which continues to do well is capex goods, infrastructure goods, and I think that's in line with the strong public sector capex we are seeing in the system, at least in the last couple of months, which was also very clear in the GDP data yesterday. So in a way, I'm also differentiating between investment and consumption, Pallavi. Investment is far more buoyant than consumption at this point of time. And within investment, I would say it's largely driven by the public sector, both the center and the state in the last couple of months. Consumption is not looking, similarly good. I'm going to make one small point. There's a strong identity between investment, consumption, and savings. Investment remains very strong. In this quarter, we saw that the current account deficit changed. The only way that can happen is if savings rise. So savings rose in this quarter, and higher savings means lower consumption. So we were seeing a quarter in which to keep this whole savings, investment, and current account deficit identity intact, higher investment could only have been made possible by lower consumption.
All right. But what about private demand in Q1? Like the figures yesterday, it did see a fair rebound from Q4. Private consumption expenditure, I mean.
Current private consumption expenditure. So look, there is a lot of seasonality in the system. Year-on-year numbers are a little messed up because of base effects, particularly in the first quarter. So for me right now, the best indicator, Pallavi, is to look at private consumption of GDP as a percentage of overall GDP and compare it to the same quarter last year. So if you compare the first quarter of FY24 with the first quarter of FY23, you see that the private consumption expenditure actually has fallen, whereas investment has remained strong at 34% of GDP.
Got it. All right. So, there's lots happening globally as well. We've seen China cut payment and mortgage rates. What does that mean for commodity prices going forward? Incoming data from the US as well has not been particularly strong. So, I do want to get an overview from you on a bunch of these global developments and what the likely impact on the Indian economy going forward is likely to be.
Yeah, look, if global growth slows, then India's growth has to slow for the simple reason that exports is a large part of our GDP, and over the last couple of years, exports growth has been a strong driver of overall GDP growth. So if global growth slows, then India has to slow. One very interesting channel is services exports. Services exports have been a strong driver of GDP growth over the last year, also a strong driver of a high current account balance. But if that slows on the back of GDP growth slowing globally, then that hurts the current account balance and also it hurts GDP growth. I think that is one. The other factor counteracting this is that if global growth slows, then perhaps commodity prices can slow and that will benefit India. So overall, the net hurt for India may not be as much if commodity prices slow. Unfortunately, we are not really seeing commodity prices slow very much. In fact, in the last couple of weeks, or you can say month or two, oil prices have actually risen. And now we're also seeing global food prices to face some pressure. And I think there's a lot of geopolitics going on. So in a way, we have to be very careful because global growth is weak. And yet commodity prices haven't really slowed as much as we would have liked them to slow. So India needs to be very careful on the growth front.
All right. So, to close this conversation, would it be fair to say, like you pointed out earlier, that the moderation we will see going ahead is partly attributable to statistical factors? However, sequential momentum or, economic momentum remains intact. What's your takeaway? How do you perceive growth going forward, and what are the headwinds that the Indian economy could face?
Yeah, you're absolutely right. I think some of the slowdown will be on the back of the base normalizing. So don't get very scared. I think that's one. But at the same time, there could be some sequential softening as well if rural demand continues to remain under pressure. So I would be watching rural extremely closely. And I would also be watching exports data because they are the best indicator of global growth. So I would say, look at rural, and there are a lot of indicators. We get very good data on rural wages. We get data on two-wheeler sales, non-durables production. Look at all of that and also closely look at our real exports data, which we get every month. And I think between the two of them, we'll get a very good grip on what growth on the ground is.
All right. That was a most insightful conversation, Pranjul. Thank you so much for taking time out.
Great to be here. Thanks for having me.
Thank you.